Hello everyone, my name is Kevin Sierra Moran, and today we're going to be talking about funding options for your small business. Today we're going to explore three key topics: business funding options, banking strategies, and how to apply for a loan. To begin, let's talk about small business funding options and the strategies to overcome some common barriers. I'll go into detail about the different terminology used and what type of funding can be used for your business. To begin, let's start by asking the question, how will your business use credit? A couple of common uses are, number one, starting a new business and paying for startup costs. Number two, for growth or expansion of your business, whether you want to add a new product or service or upgrade your current product or service. Number three would be for working capital, which can include things like operating costs, payroll, or a cash reserve. And number four is for major purchases such as vehicles, equipment, or real estate. There may be other reasons for your business to use credit, but it's important to start with this question before you begin looking at your lending options. Now let's explore the two different types of business credit, which are called short-term financing and long-term financing. To begin with, short-term financing is typically used for supplies, working capital, and to meet short-term goals. The type of short-term products include credit cards, lines of credits, and overdraft protection. Some features of this kind of credit include having a defined credit limit. For example, when you get a credit card, you're given a credit limit that you cannot go over. And if you use the credit card, you're only charged on interest on the amount that you use. This type of financing may be unsecured and not require any type of collateral. They can be used for more flexible purposes and are typically revolving. The idea is that you use the credit and pay it off, and use the credit again and pay it off again. This is one of the benefits and flexibility that short-term financing offers. However, since it is unsecured, you may potentially have a variable interest rate. On the other hand, long-term financing is primarily used for purchasing real estate or equipment, but it can also be used to purchase any fixed amount of products or materials. The main long-term financing product is called a term loan. The term loan provides a fixed amount of credit that you will be receiving and is used for a specific purpose. For example, you may be interested in purchasing a new machine for your business. When looking for a term loan, you will know exactly how much the machine costs, and that is how much credit you will ask for. Term loans are also typically secured with some form of collateral, which can include things like a car, house, or some equipment of value. These loans are also paid over a fixed period of time in installments. Similar to how you pay off a house or a car, you pay a certain amount of money each month for a specific set of time, whether that be 5 years, 10 years, or 15 years. Lastly, because term loans are collateralized, they usually have a fixed interest rate. Okay, now let's talk about some considerations to keep in mind when you're exploring your credit options and determining which one is the best for your situation. First, start with the question, why do you need the money? Is it to purchase specific materials or supplies? Is it for operational costs, or is it to cover startup costs for the business? Second, ask yourself, how much money do you need and what type of repayment terms are you looking for? Would you prefer to have a revolving credit or a fixed credit? Are you looking for variable or fixed rates? Lastly, it's very important for you to consider whether or not you can repay what you borrow. This can be done by projecting your future business revenue and having a better understanding of your personal financial situation. Now let's talk about some short-term financing options. I previously mentioned that three common options include credit cards, lines of credit, and overdraft protections. Business credit cards work similarly to personal credit cards in that you are provided with a credit limit and you are required to pay minimum payments to that credit card every month. Credit cards can be very helpful if you need support with immediate small purchases. A business line of credit is similar to a credit card in that you have a credit limit and can pull from that funding whenever necessary. For both credit cards and lines of credits, you only pay interest on what you borrow. Lastly, Overdraft protection is a mini loan that is offered to you as a security measure to prevent you from overdrafting funds from your checking account and having to pay fees. When talking about long-term financing options, again, that is considered a term loan. In a term loan, borrowers receive a lump sum of cash in exchange for a scheduled repayment plan and agreed upon interest rate. These loans can be used for real estate, new equipment, or to support your business start or expansion. There are a variety of different term loan options available, and federal, state, and local assistance programs to assist small businesses with obtaining these loans. Banking strategies. So now that we know more about small business funding options, let's talk about banking strategies to help you prepare for your loan application. When we are seeking financial support, it is important to consider three key concepts that influence your financial position. The first one is your personal and business credit history. Almost all lenders will ask to see your credit report as a way to establish your character and determine the risk involved with the specific loan. By using your credit responsibly, you can demonstrate your creditworthiness and financial responsibility, which will help your lenders feel more confident in lending you money. Things like paying off bills on time and keeping your revolving credit utilization low can strengthen your credit report. Next would be to have updated financial statements. Consistently updating and reviewing your financial statements is a great way for you to keep track of your business's financial health. These statements provide key insights into your business and show where your money is going, where it's coming from, and how much you have to work with. Lastly, you want to consider the external factors that may be impacting your business. The current state of the economy, industry-specific conditions, and policy changes could affect your business in negative or positive ways. When you are evaluating your future strategic goals, it is important to keep in mind how these external factors will interact with your business. Uncovering how lending decisions are made. So there are many factors that play a role in the lending decision for your business. Some things to consider are what are called the 5 C's of credit. They are character, capacity, capital, collateral, and conditions. Character is evaluating the borrower's credit report and previous history with credit to determine if they are someone that can be trusted. Capacity is an evaluation to ensure that the borrower has enough income to repay the loan. Some factors that are considered include debts, income, and employment stability. Capital examines the borrower's financial resources and net worth to determine their ability to absorb potential losses or make payments to the loan. Collateral refers to an asset that is pledged as a security for the loan, which can be seized if the borrower defaults on their payments. And lastly, condition examines the overall economic climate and specific circumstances surrounding the loan request. These 5 factors are commonly used to determine lending decisions, but are not the only ones used. Other factors may be included depending on the specific situation of each loan request. Understanding key financial statements. Earlier I mentioned that updating and reviewing your business financial statements is an important way to understand your financial position. Let's talk more about the 3 important financial statements for any business. The first one is called the balance sheet. This document is a snapshot in time of what a business owns and owes, as well as the amount invested by shareholders. The report is split into 3 main sections, which are assets, liabilities, and equity. Secondly is the income statement, also referred to as the profit and loss statement. This document reports a business's financial performance over a specific period of time. The report shows your business revenue, expenses, gains and losses, as well as your net income. Lastly, the cash flow statement shows all of the money coming in and out of your business for a specific period of time. It is different from the income statement in that it includes operating, investing, and financing transactions. For example, a loan or grant can be seen in the cash flow statement, but would not traditionally be seen in the income statement. Vigilance is key to effective business financial management. It is important to consistently update and review these 3 documents to have a better understanding of your business's financial health. Understand your capacity to pay debts with the debt service coverage ratio. So when banks are determining the loan amount you qualify for, they combine your personal and business income to see if you have the capacity to make the loan payments for your total income. Business income can be determined by reviewing tax returns or financial statements that reflect the ability of a company to generate a profit. The debt service coverage is expressed as a ratio of 1.25 to 1. This means that a bank expects $1.25 in personal and business net income for every dollar of business debt. How to apply? So now that we have covered funding options and banking strategies, let's talk about how to apply for a business loan. When applying for a business loan, these are the steps you should expect. To begin, you will submit an application to the lender. This includes gathering all of the documents that the lender requests and working with the lender to complete the application. Once you have submitted your application, you will be provided with a loan decision. If you meet the criteria of the lender, then you will get approved with specific repayment terms. You may also be given a counteroffer by the lender or be denied for your request. If approved and you agree to the terms of the loan, the lender will then conduct due diligence to confirm the information about the business owner and the business itself. Next, the lender will review the loan repayment terms with the lender and conduct signatures for the loan documents on what is called loan closing. Finally, after you have signed the loan documents, the lender will work with you to distribute the loan proceeds in the agreed upon method. This could be a check or a direct deposit to your business bank account. Before you submit the loan application, here are some things to consider. First, ensure that your business is properly registered with the state that you are operating in and has all necessary business documents. Next, when completing the loan application, clearly state the purpose of the loan and the amount that you are requesting. I would also highly encourage you to review your personal credit report to ensure that it is accurate and up to date. You also want to research your borrowing options to ensure that you are making the right choice for you and your business. Make sure you have updated financial statements and a business plan prepared. And lastly, gather all documents that the lender may require for the loan application. To help improve your ability to secure a business loan, consider following these best practices. Maintain separate personal and business banking accounts. Review your business financials regularly. Create a business plan and update it often, and enlist professional help when needed. We covered a lot of information in this presentation. Thank you so much for sticking with me. Let's quickly go over 3 key takeaways. Number 1 is to position yourself for personal and business financial stability and growth. This can be done by consistently reviewing your credit report and financial statements. Number 2 is to seek out educational tools and resources. There are a lot of great resources and programs out there to support small businesses. I encourage you to find the resources in your community. And number 3 is to build a network of trusted experts, mentors, and advisors. No one can do it alone. If you would like to find more resources to support your business, I have included them in the slide below. Today we learned about small business funding options, banking strategies, and how to apply for a loan. Thank you so much for your time and attention.